Hi, my name is Stuart Weems and welcome to the Investopoly podcast. Our goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And if you're listening to this episode on New Year's Eve, please let me start by wishing you a fantastic new year. And I certainly hope 2025 is going to be a great year for all of us, of course, including investment markets and property markets and those sorts of things. And if you are tuning in, I will be on the Money Puzzle podcast, which is the Australians podcast on the 9th of January. And James Kirby, the editor, and I will talk about what our expectations are for the property market in 2025. So if you're interested in that, maybe watch out for that episode as well. And I think equity markets will also be relatively interesting. It's going to obviously be dictated a lot or influenced a lot potentially by what Mr. Trump does in the US. So anyway, as long-term investors, we don't really care that much, do we? I wouldn't have thought. Political parties and presidents and prime ministers will come and go. Really, the fundamentals of investing don't really change. Anyway, let's get into today's Q&A episode. All right, so the first question is from Rob. Rob writes, I'm weighing up the pros and cons of superannuation investment versus property investment after having been burnt by property investing previously. Our scenario is my wife and I are in our 40s with kids. We are medium income earners earning a combined $220,000 a year with not too much scope for our income to grow, and while we do enjoy doing our jobs that we do. We live in outer suburb of Perth with a home and we've paid off the mortgage. The home's worth $850,000. We recently sold 3 poor quality Perth investment properties after holding them for 9 to 12 years. The properties each made a small profit, but it wasn't worth the 12 years of effort and opportunity cost. The properties were each low value, poor choices requiring high maintenance in outer suburbs with poorly timed purchases. We now have no investment property. The last few years we've found success investing our spare cash flow in superannuation. They have a combined balance of $500,000, and investing in ETFs outside of super combined balance of $300,000. Should we continue to invest our spare cash mainly into maximising concessional superannuation contributions with a little bit of ETFs outside of super? Super takes advantage of the tax breaks. The investment has felt easier and has been more successful for us. Or should we try negative gearing into investment property, which will take up most of our spare cash flow? Great question, Rob. I'm not sure I can give you some definitive advice here, of course. And of course, everything in this podcast is not personal advice. I can certainly tell you what are the things that I would be thinking about in your situation. So you have been burnt by property investing, but I think it's important to reflect. I'm not suggesting you're saying otherwise, but I think it's important to reflect, well, what went wrong here? Well, timing was poor. You bought just after a growth cycle in Perth and, you experienced a full flat cycle and you bought the wrong assets. I always talk about, the quality of the assets instead of spending that money or spreading that money across 3 assets. Probably should have put it into 1 asset. But even if you did that in Perth, you're still probably not going to be better off. But if you invested those monies 9 to 12 years ago in Brisbane, for instance, you'd be in a completely different position. So it's not that property investing doesn't work, it's the implementation in that situation that didn't work out for you. It's really difficult, the next observation I would share is it's difficult to convince someone that an investment's not going to work if it's worked for them. So I'm talking about, your approach over the last few years in terms of maximising super contributions and investing in ETFs. It's difficult for me to say to you, that's not going to work over the next 20 years because you go, well, hang on, Stuart, it's worked for me so far. I just find, people tend to, I don't know, it's just difficult to kind of interrupt that behavior. But, the thing we need to think about is, certainly equity markets, and particularly driven mostly by the US, because the US accounts for 70% of global developed markets, of course, have had a tremendous run. And they might continue to have a great run. I'm not suggesting that it's over. But whereas property over the last 5 to 7 years, excluding, Brisbane Adelaide and Perth have done pretty well, but Melbourne and Sydney not so well. And, I think that's probably a normal situation where we're going to have some asset classes that have performed well at different times. And so having some diversification kind of helps. So at the moment, you've got a home, so property exposure in Perth, and you've got $800,000 of investment balance, between the ETFs outside super and your super balance. You're in a pretty strong position, I would say, for your mid-40s on that sort of income. So what would I do? Well, I'd kind of like, given you've got 800,000 invested in share markets, I would kind of like the idea of investing in property just to build some diversification, particularly if, let's say, the next 10 years in equity markets isn't so great. Well, at least you've got some diversification, you're picking up some growth. But if we wanted to invest in property, where are we going to do that? You could invest in Brisbane. I think Brisbane still has some time to run. You could invest in Perth. I suspect that you might find it really challenging. I mean, it's challenging to buy property in Perth as it is, given the level of competition and given there's a lot of investors from the East Coast investing in Perth at the moment as well. I think locals would find it difficult to get their head around the prices being paid necessarily, and that tends to be true because property, I've spoken about this before, property markets can move very quickly and it can spook people, and it's very difficult for those people to, keep up with the fact that, hey, this property 2 weeks ago would have sold for $50,000, $100,000 less, but the new price is $50,000, $100,000 higher. It moves like that. That's how it's always behaved. But, just psychologically, it's difficult to kind of keep up with that. You could go and invest in Melbourne, for instance. You know that I've spoken about Melbourne a lot in terms of its future expectations, but your budget will put you into the apartment market, and I think the apartment market is intrinsically undervalued, but the risk is that you're not going to see immediate returns, and you then might just start thinking, well, have I just repeated the same mistake that you've repeated elsewhere? So I don't know. I think on balance, I would continue as is, just because I don't think that there's a compelling, in your situation, given the budget you will probably have, a really compelling opportunity in the market that has a very high probability of generating good quality returns over the next 10 years. I think there are opportunities, but I think they're probably outside of your range. As like a house in Melbourne, I think will do really well. And I think has lower risk than apartments, because we can change apartment supply, although we can talk about all the reasons why that might not happen overnight. The reality is that it can be changed. So I prefer a house. And because I think we're just where markets are in the cycles and budget and borrowing capacity and cash flow, I reckon you've built a really good base already. So I think it's just about making sure that what you have, the 800 you have today, is well invested, it's going to perform and compound. And then I think if you can contribute to that, I reckon that's probably the simplest, easiest, cost-effective approach to building wealth. Okay, Katrina's got a question about capital gains tax. Katrina writes, I was listening to your podcast of yours recently about the live investing strategy. If I had an investment property that I've held for 10 years and decided to knock it down and rebuild it as my principal place of residence, what are the tax implications? My concern is that it's an old building, and if I knock it down and rebuild and live in it, then most of the capital gain will happen while it's my principal place of residence. However, when I sell it down the track, will CGT be calculated up until I knock it down and rebuild, or will it be proportion of days? Katrina, it will be proportion of days, because if the property is an investment property immediately after you buy it, then you need to apportion by number of days. If a property is occupied immediately after you buy it and then you rent it out, it's based on the market value of the property when it first becomes available for rent. In your situation, though, of course, it's been a rental property for 10 years, so it'll be apportioned by number of days, but the cost base, so in terms of calculating that capital gain, will include what you paid for the property 10 years ago and any purchasing costs like stamp duties and so forth, plus any capital improvements that you make to the property. So when it comes to calculating the capital gain, the cost base will actually include the cost to rebuild, knock down and rebuild. In fact, whatever you spend on that asset will go towards its cost base. And since it's your primary place of residence, you can't claim any depreciation on that cost base. So the hard cost will be the capital gain. And then, of course, the longer you live in it, the more you dilute the period of which it was an occupied property. So, for example, if you've owned it for 10 years and you go and occupy it for another 30 years, well, only a quarter of that capital gain will be taxable. And then obviously you can apply the 50% CGT discount. So you're not really then probably talking about a huge amount of tax. But anyway, that's how that is most likely going to be treated by the ATO. Okay, next question is from Steve. Steve writes, in your excellent episode of 326, thanks Steve, you mentioned that if you repay part of a loan that has been used for two purposes, say home and investment property, you must apportion the repayment between those two purposes, which is correct. Steve writes, I have a loan that was used to pay for a deposit for two investment properties, let's say $100,000 for property A and $100,000 for property B. I sell investment property A and pay down that loan by $100,000. It now has $100,000 owing, I should say. Can I say to the ATO the $100,000 owing is $100,000 used for property B, so it's tax deductible, or do I have to repay $50,000 off to the deposit of property A and $50,000 for the deposit of property B? The strict answer there, Steve, unfortunately is the first option. You've got a $200,000 loan, 50% is related to property A, 50% property B. You put $100,000 into that loan to reduce it to 100, and you have to apportion that repayment across both property A and property B. And the reference here is tax TR 2000/2. And if you go to paragraph 20, I'm really nerding up today, aren't I? Sorry, paragraph 21. That's where that's the tax ruling that dictates this approach. Now, in reality, that's what I think the ATO is going to look at. Like if you went through an audit, in reality, I think it's a pretty low audit risk. And so you might just decide, the remaining $100,000 relates to property B, and you continue to claim interest in respect to that if property B is an investment property, of course. But strictly, that's what it looks like. Now, when we go and sell a property for a client, we will then, at that stage, consider whether we need to restructure the loans before we go and sell that asset. And in fact, sometimes what we do is restructure the loans to the extent where the asset we're going to sell is completely unencumbered if we've got equity in other property. And that way we have full control and use of the sale proceeds monies, as opposed to if you have loans that are cross-securitized. So that is where there's more than one property securing loans. It means the bank can then dictate how much you need to repay against what loans, and they've got full control over the funds. So, and similarly, if we have a loan where we've got, say, like you have, Steve, two deposits in the one loan, we will go and split that loan out before we go and sell the property. So it's really important. I mean, these borrowing capacity things, interest is your biggest tax deduction. From a property investor's perspective. And, what we want to do is minimize the holding costs and then making sure we're deducting as much interest as possible that we're allowed to deduct, I should say, means that we'll maximize our tax benefits, which is critical ultimately to increasing your investment return. So these loan structuring considerations are actually really important. So sorry, Steve, probably not the answer you're looking for, but I don't think it's that big a deal in the scheme of things. This is not tax advice, of course. I think if you went on your merry way, I think your audit risk is pretty low. Okay, next question is from Christine. Interesting question. What are the benefits and disadvantages of adding our adult children to our self-managed super fund? One is 20 and the other is 22. The balances are small at present. Our self-managed super fund's current value is $1.4 million with some large contributions to be added into the future, including a $600,000 downsizer contribution. We are 54 and 55 and we'll look at pension phase from age 60th. We do our own investing and believe we can do better in terms of returns for the kids than their current industry fund. I'd appreciate your insights. Christine, I'm not a big fan of having children in a self-managed super fund for two main reasons. The first one is that you're at different ages and stages in terms of life. I hear what you think you can beat the industry super funds. I'm sorry, but as a financial advisor, I would say that that's a very optimistic approach. I'm not saying the industry funds are doing incredibly well, but I just really caution anyone that thinks that they can beat the broader market. And if we're looking at the average returns across the 8 industry, prominent industry funds, I think that's a pretty significant benchmark. I'm not saying it's impossible to beat it, but by what margin? And I just don't think I just caution people, making that assumption that over very long periods of time, they're going to be better off. But anyway, it is what it is. But my point is that you're at different ages and stages of life. You might have different risk profiles. You might say to me, look, Stuart, that's fine, but we can maybe quarantine assets and do those sorts of things. But, I just don't think it makes sense to have one pot of money for 2 members that are in their early 20s and 2 members that are in their mid to coming on to late 50s and then approaching retirement. But the biggest concern that I have with kids inside a self-managed super fund is if they get into a relationship and then they're subject to a relationship breakdown, that is a family law matter. So, of course, spouse or de facto and then separating. What it can do is lock up the super fund. So I've heard of situations, not my clients, but another advisor's clients, and it's happened on a few occasions where we've got children in a self-managed super fund. The children go through a divorce, ugly divorce or separation, and then the parents can't do anything with the super fund because these children are members, and they actually sort of stop the trustees from making any changes. I'm not sure about the legalities of it and the situations and those sorts of things, but when you've got young kids that aren't in a stable relationship yet, or even if they are, I mean, things can change. I just don't think it makes a lot of sense. I reckon if they're in a really good industry super fund that with low fees, I talk about UniSuper, for example, and they're in high growth, because they're in their 20s. I reckon it's a pretty good solution. Exactly what I've told my sons to do. I don't think, and I've got a self-managed super fund. I don't think I need to involve them in that. Okay, next interesting question is from Edward. Edward writes, my question relates to considering to sell an investment property when it's performing okay. From the episodes I've listened to, it sounds like it's easier to sell a property if it's a dud. But what if it's performed well, but you see better potential in other markets? I'm not sure it's easy to sell a dud property, Edward. I think it's probably easy to make the decision as in, I don't want to keep this property anymore. But of course, it's a painful situation when you have to realize you've made a poor investment. Anyway, I jest a little bit. Edward continues by saying, my real life example being that of my wife and I purchased a $410,000 semi-detached property in regional market in Bendigo in 2010, $300,000 of debt. It's now worth $550, approximately 7% annual growth, and receives 7% net rental yield. On a short-term basis, it's likely to yield about 5% on a long-term permanent tenant basis. Although it's performed well, based on the information we hear on podcasts like yours, we aren't overly hopeful for market in the future compared to other markets. And we don't love the semi-detached nature of the property for primary place of residence appeal compared to other properties. So my question is, even if the property isn't a dud, is it worth considering selling a property like this to upgrade in location, like capital city in Melbourne, and crystallise our lucky regional Victorian property timing? I'm sure lots of listeners can relate to similar purchases they hold and are speculating opportunity costs of holding. In case it's relevant, my wife and I are in our early 30s, receive $300,000 annual income. We also have a $500,000 primary place of residence debt and hold 2 other regional properties, one in the Mornington Peninsula. Okay, Edward, great question. And you know what? I really should have better defined the podcast episode on, when to sell a poor performing investment. And I really should have inserted a paragraph to talk about this exact situation, because I guess there's two considerations, right, when we're thinking about how will these assets contribute towards our retirement. The first thing is, well, we look back at past returns, because sometimes that is, in fact, with property, it's often an indication of likely future returns. So that is, if I've held a property for 20 years and it hasn't seen any growth, why do I think the next 20 years are going to be different? In which case, sell that asset. And that's been really the focus of some of those podcast episodes. What I should have addressed is, okay, even if the past growth has been good, what we should really do is form a view on future growth, because that's the key, right? Because what we need to do is ask ourselves, how have we invest our assets today, and what contribution will they make to our retirement? And then how will we invest future income, and how will that make a contribution to our future retirement? So it's a really good point, and one that I've clearly missed in terms of the other episodes. Of course, regional, we're talking about Bendigo. Some of these regional towns, and that's true outside of Victoria as well, in New South Wales and so forth, have really benefited from a massive boom, obviously during the COVID period when everyone wanted to get out of Melbourne, particularly in Victoria, because Melbourne was subject to much harsher lockdowns. But then also, rising interest rates and the contraction in borrowing capacity has sort of pushed people out to the regions as well, both from an investment perspective and from an own occupier. So it's sort of been, the events over the last couple of years have kind of conspired to really driving those markets higher and stronger. And particularly if you look at the type of asset you've bought, because if I own, say, a house in Bendigo in a really great street, let's say it's a period style property, for anyone that knows that market, there's a lot of period properties in Bendigo, then I wouldn't sell it. Even though I would say, okay, I've experienced probably above average growth over the last couple of years, I would still say, look, it's a really good asset. But so the location doesn't really worry me too much. I think Bendigo has a lot of appeal. Bendigo, Ballarat, Geelong, they're the regional towns where, just broadly, I think, I'm not saying they're great towns, but broadly, I think you can do okay as a property investor. But the semi-detached nature of the property, maybe you're right, maybe that's not going to have as wide appeal. It's getting a good rental yield. Of course, you do it on a short-term basis, but let's look at the long-term rental yield of 5-ish%. So that means its holding costs aren't too bad. But one thing, and I'll be doing episodes in it in 2025 next year. In fact, which is only tomorrow as I record this podcast. I'm going to talk more about the scarce asset, and the scarce asset is borrowing capacity, right? So it's not really, cash flow is a scarce asset too, in terms of how we allocate our cash flow, but borrowing capacity is something that we really need to think about. So you've said, Edward, you've got $300,000 of debt against this property that's worth, say, $550,000. The thing, if I was in your situation and you were my client, I'd be looking at it. I would say, okay, my risk is that this Bendigo property is going to underperform. I want to mitigate that risk. If I could then go and buy a house in Melbourne, investment grade house in Melbourne, and invest in that, I would do that and still hang on to Bendigo and just see how it works out. But at least I've got another asset there to mitigate the risk of, the underperformance in Bendigo. And if then I did notice that Bendigo was going to kind of level out, I'd probably divest of it and exit that market. And I'm okay because I've got that fallback position of having the house in Melbourne. If I couldn't afford to do that because of borrowing capacity, then what would I do? Well, if you've got another property in a regional location, Mornington Peninsula, I would probably go into Melbourne proper. And just from a property portfolio diversification perspective, you're going to be in a different market. Obviously, capital city market has different demand supply attributes than an outer market. And a regional market's going to probably be more volatile than a capital city market. Kind of strange to say, given where sort of Melbourne and Victoria are at. So I think I would lean towards, particularly if you thought the asset was slightly impaired just because of that semi-detached nature. And that's probably, I don't know the Bendigo market super well, but I imagine freestanding houses would be preferable in that market just because they are more affordable. A lot of people don't need to make the compromise of having a semi-detached property. So in that situation, I would probably take my money and run. I would say that the other consideration that you put in your question is that you've got $500,000 of non-tax deductible debt. So I guess whilst you're going to have to pay some tax, crystallising that gain, which is going to yield maybe $250,000 after you repay the loan. And look, maybe you've got to pay about 40 grand of capital gains tax or something like that. Maybe it's less than that. It's still going to put more than $200,000 in your pocket, which means that you can make a substantial reduction to your home loan. It's not the reason for it, but I think it's just an additional benefit of doing it. But if you can't afford to go and buy the Melbourne house and still hang on to Bendigo, then yeah, I probably would sell Bendigo. Okay, next question is from Jack, a bit of a niche one from Jack here. Jack writes, I'm a 35-year-old expat living in Jakarta, Indonesia, and extremely happy despite my mother wanting me to return to Australia. That's all right, Jack, live your own life, it's all good. I'm aware at some point I'll be required to return and have invested substantially into property, 3 residential and 1 commercial, and superannuation. I'm concerned whether I should be trying to future-proof myself and purchase a property in a potential lifestyle location, e.g. Melbourne. Do you think it is better off I buy a place that could be my home or continue down the track of investing? Well, firstly, Jack, I'm going to assume you're a non-tax resident of Australia. I mean, if you're, permanently living in Indonesia, that's most likely going to be the case unless you work for the Australian government or something like that. So if you are a non-Australian tax resident, it means that you're not entitled to the 50% capital gains tax discount, and rental income will be taxed at a higher rate because a non-resident tax rate if it's positive. If it's negative, you're not going to get any tax benefits, negative year-in tax benefits in Australia. So I would say, hope you realise the tax consequences of being a property investor and a non-tax resident. And generally, if I have a non-tax resident, unless there's some extenuating circumstances, just generally, I'm not investing in property. Because as you can imagine, if you don't get the 50% tax discount, then essentially half of your capital gain will be a tax liability. And really, that's the main benefit of investing in properties, that compounding capital growth. If you're paying half your return in tax, it obviously means that the after-tax return is substantially lower than, say, for example, if you invest in ETFs in Australia, that's not going to attract any capital gains tax or income tax, most likely. So that's the first observation. The second experience and learning I can share with you, Jack, is no. I think you still make some pure investment decisions. Don't worry about lifestyle considerations. In my experience, things can change a lot, particularly with expats. So particularly in terms of timing. So sometimes expats, we don't tend to deal with them anymore because it's quite difficult from a compliance perspective. But if we do have an expat that's a client, and they say, "Oh, we'll be overseas we're coming back in 2 years' time," I know it's not going to be 2 years' time. I've never had a client that when they think they're going to be back in 2 years' time, that they have been, and it could be 10, it could be 15 years that you're overseas. So things change a lot, and people kind of get used to that lifestyle. And so whilst their job might end in Hong Kong, they might end up somewhere in the US working and so forth. And plus, you're 35 years old, so a lot can change in your life in terms of desires as well. So it makes it really challenging to, with a high level of confidence, to decide, okay, I want to live in a period property in Carlton, for example, in Melbourne. The chances of being able to identify exactly the type of asset you'd like to live in, the type of location, given that it's completely unknown when you're going to come back, really challenging to do. And so as a general rule, and there are exceptions to this, as a general rule, we prefer not to buy a family home, a potential future family home, unless we're absolutely certain, unless the client's absolutely certain that they know exactly where they want to live, and it makes sense to buy it. So we're trying to mitigate the chance that property prices rise too quickly. But anyway, I think that's the main point there, Jack, which has got nothing to do with your question, is really about expats investing in Australian property. It's not something I'm that keen on. Okay, next question is from Georgia. Georgia writes, I'm interested in your views on my husband and I's situation. We both earn decent salary. He's 40 years old, earning 185 plus super. I'm 37, earning 135 plus super. We recently bought a house which we live in. Remaining mortgage is 720,000 with around 700,000 of equity, so about 50% LVR. We have 150,000 sitting in the offset. Having lived overseas for a while, my husband is originally from the UK. Our super balances are a bit behind, but we have a few small pots in the UK and we'll be able to get the full state pension at age 68. We're in the position where we have around $5,000 to $6,000 spare per month and we're looking to make the best use of it. At the moment, it's all going into the offset, but we're thinking whether we should be maxing out our super contributions or whether it makes sense to put the balance in the offset or bring in some ETFs into the mix. We're happy to put money away from the medium to long term, as in 10 to 20 years or more. We're planning on going through IVF next year, so if that's successful and our cash flow will drop, which means we'll have less spare cash to invest. I know you've done a few episodes on mortgages versus super versus investment, but still keen to hear your views on our situation. Okay, Georgia, that's a really interesting one. Based on what you told me and the key bits that I'm really thinking about are super balances are lower than usual. Again, that's not uncommon with kind of people that have moved to Australia or have worked overseas. Strong cash flow, and you're in your 30s to 40s. I know he's 40, your late 30s, if you like. So, 20 years away from retirement potentially, need to build that asset base. I would immediately start thinking invest in property, particularly you've got $5,000 to $6,000 spare. And it sounds like you're pretty good savers in terms of managing cash flow because you've got 150,000 in your offset account. And whilst that means your net debt is 570,000, it's not a tiny amount, but it's not, an amount that's, relative to the asset value over 1.4. It's not that big a deal. So I would be leaning towards, why don't you go and buy an investment property? You've got 20 years to be able to hold it. Over that period of time, it's going to do great things. And then potentially what you could do is sell that investment property, potentially, I should say, in 20 years, and then make some non-concessional contributions into super to try and get more money into that super account as well. Notwithstanding that, buying investment property will help you underpin super. So, if you buy it today, you've got 20 years to let that property do its thing. Meanwhile, you'll be making contributions into super, your employer contributions. And whilst you might have relatively lower bases relative to your peers that have been in Australia permanently, by the time you get to 60, at least you've got this other asset to kind of underpin super, which means that if your super doesn't last as long as you might hope, you've got this other asset to sell. So I'll be thinking about investment property. Now, the only sort of spanner in the works is, starting a family. And so that's something you might want to think about. And I think it really comes down to risk profile. Because if you're going to start a family, and also depends on your future plans as well, in terms of how long will you have out of the workforce, how long will you be out of the workforce for, and those sorts of things. And look, I like to be conservative around clients that are sort of starting a family because you never really know how it's going to work out. As someone that's had one myself, some people have children, and it doesn't really, it has an impact on their life, of course, but, it doesn't have a huge impact on their life. Other people have children, they can be quite sickly, or there's other challenges that they're sort of dealing with and can really be a challenging period. And can also, be a bit of a spanner in the works in terms of plans to return to work as well. So you never really know how it's going to turn out. So I just like to be careful with that sort of consideration and be a little bit more conservative. But my argument would be, well, you got $150,000 of cash flow. I don't know what you spend per year, but I would imagine that's going to be at least 12 months of living expenses, potentially up to 2 years of living expenses. So you've got quite a bit of a buffer to sort of push you through. If you don't buy an investment property today, and you start a family and start having children, you might actually turn your mind to saying, okay, we're ready to buy an investment property for potentially 5 to 10 years. It's not really till the kids go to school that families tend to sort of recover their income and cash flow. So really, you could be, if you don't do it now, there's a window of opportunity to do it now. If you don't take that opportunity, you might not be able to get into the market for another 5 to 10 years. So I would say, let's go and buy an investment property. Let's look at the 150,000 that you got in the offset as your cash buffer. I'd probably build in as much buffer into the investment property loans as well, just in case there's unforeseen expenses or these sorts of things. And then as long as you're comfortable that 150,000 will help you sort of ride out that period of, maternity leave and higher expenses and lower income, then I would do that. If you weren't comfortable with that, then I'd be leaning towards maybe some in offset accounts, so maybe 50% of your cash flow or 40% of your cash flow going into the home loan offset. And then the remaining amount into some ETFs outside super. Now, I wouldn't say put more money into super necessarily, because you're in your sort of 40s, you're going to start a family, so you want to have access to those monies in case you need it over the next 20 years. So I would say start building some of those assets outside of super. And then obviously in maybe 10 years' time, for example, you might then start saying, okay, I'm going to start putting more of my cash flow inside super, because as you get closer to the 60 and being able to access it, the fact that it's locked away becomes less and less of an issue as you get closer to that point. But that's probably how I would approach this situation. I hope that's useful for you, Georgia. Bit of a longer episode today. Sorry for that, particularly if you're listening to it on New Year's Eve. Again, I wish you have a fantastic 2025, and very much looking forward to sharing more of these podcast episodes in 2025. If you have any feedback or questions, please send them to us at questions@investopoly.com.au, and enjoy the rest of 2024. And thanks a lot. Cheers.